Is Apple, ticker symbol AAPL, a good stock to buy now? Apple just announced the biggest share buyback program in history, but at the same time, Warren Buffett confirmed he's been selling the business in the last 3 quarters. Still, it's his biggest position. So is Apple really a buy or is it a sell? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Apple using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Apple is truly worth in today's stock market. Plus, I'll share a special bonus that could be the deciding factor when adding Apple stock to your portfolio. Right now, Apple trades for $181.62 per share. In the most recent day of trading, it's down 0.96%. However, in the last year, Apple's stock price is only up 0.5%. This underperforms the S&P 500, which is up 23% overall, with much of this underperformance coming in 2024. However, the last 5 years, especially since the pandemic, are a completely different story. Apple is compounding its stock price at 30% annually. In 2023 alone, their stock was up 50%. We see continued outperformance going back for the last decade. Warren Buffett originally bought the business in early 2016, and in this time, Apple has compounded at 22.7% annually. They've crushed the market, and that's not even counting their dividends. Right now, Apple pays a 0.55% dividend yield that's in addition to the gains in their stock. And as we go back prior to the global financial crisis, in the last 19 years, Apple compounds at 29% annually. Even with their recent declines from all-time highs, Apple is perhaps one of the best stocks over this time. Today, Apple trades $18 below their 52-week and all-time high, but they're still up $17 from their 52-week low. And how big is Apple? Today, they have a $2.75 trillion enterprise value. That's good enough to make them the second biggest company in the world. Getting started with metric number 1, we want their average return on capital to be above 14%. Apple's not going to have any issues here. They earn very, very high return on capital numbers that have only been increasing over this time. Pretty much since 2020, these returns have been sky high. Return on capital is important because over the long run, most stock returns are going to be about a company's return on capital numbers. In the last 5 years, Apple earns around 50% returns on capital. These are huge, more than 7 times better than a normal business. It's almost insane how high of a quality business Apple is, and Buffett even said it's way higher quality than even Coca-Cola or American Express. This is a massive check on metric number 1. In its Q1 2024 earnings call, Apple announced that iPhone sales are down and the company authorized buybacks to the tune of $110 billion. But just a few days later at Berkshire Hathaway's 2024 annual meeting, Warren Buffett announced he sold 100 million shares of Apple in the first quarter. And based on his projections for his cash by the end of the second quarter, he's likely still selling Apple shares. This comes even as they're buying back their stock. Right now, Apple is owned by 14 different super investors. Buffett owns the most in terms of shares and as the largest percentage of his portfolio by far. It's also owned by a number of Buffett followers, including the Chinese Warren Buffett Li Lu, who has 7% of his US assets in the business. More than 50% of Buffett's portfolio was invested into Apple as of the start of 2024. Even with these sales, though, because of that share buyback program, Berkshire Hathaway's ownership in Apple is likely to increase. This comes as Apple was one of Buffett's most recent home run investments. He really loaded up on the company between 2016 and 2018 after it was first bought by Todd Combs, one of his investment managers. Now, in our second metric, we want growth for the business. It's harder to make mistakes investing into growing profitable businesses. In this time, we learned that their sales have increased by 47%, going up to $383 billion in their most recent year alone. With that higher sales growth, their earnings have grown even faster, growing by 82%, and their free cash flows have grown by 73%. It's great to see the operating leverage that Apple is getting on their business, growing their profits faster than their sales. It's another massive check. Apple is one of the biggest and most profitable companies in history. Next, in metric number 3, we want to look at Apple from the view of an individual shareholder. Here we want to see that their earnings per share have increased over this time. This builds off our last metric where we learned that they've grown their earnings by 82%. At the same time, Apple's bought back 16% of their shares in just the last 5 years. Plus, with that new share buyback program, they may repurchase an additional 4%. Because of both of these twin engines working together, Apple's earnings per share have more than doubled, and it's another huge check for shareholders. However, you want to keep in mind that with share buybacks, valuations really matter. No business, no matter how wonderful it is worth an infinite amount of money. That's why unless these share buybacks come at a discount to Apple's intrinsic fair value, they may actually destroy value for shareholders in the long run, and something like dividends may have served the company better. So you do need to be aware of what prices these buybacks are occurring at. We'll look at Apple's valuations to get a better idea of this in just a few minutes. Metric number 4 is similar to our last one, but it's even more important. This ties all of these together. Here, we want their free cash flows per share to have grown in the last 5 years. This is another similar story with their free cash flows growing 73%, and coupled with these 16% share buybacks, their free cash flows per share have more than doubled. Another check means that Apple is a perfect 4 for 4 through our first 4 metrics. Do they have what it takes to keep this up? Let's find out. Wonderful companies can earn high returns, grow, and not use a lot of debt in the process. Apple is no exception. In the last 5 years, they've been sitting on an absolutely massive cash cushion, although this has come down somewhat. Apple currently has $38 billion of cash sitting on their balance sheet after they pay off all of their debt. Back in 2019, this was sitting at a staggering $98 billion, so they have reduced this somewhat. Still, over this time, Apple has nearly doubled their free cash flows, and in the last 5 years, they brought in $436 billion worth. That's insane. They have torrents of cash coming in and a huge cash cushion, which means that Apple looks like it's in great shape financially. Another massive check means that Apple is perfect through our first 5 metrics. Do they have what it takes to be a perfect select 6 stock and get a check on our last metric? Let's try to figure out what Apple is worth. But before we do that, why don't we check in on our bonus? So as our bonus, we want Apple's dividends to be covered by their free cash flows. This is another spot where Apple has flying colors. Right now, Apple pays a 0.55% dividend yield that's in addition to the gains in their stock. The company also has a very modest dividend payout ratio, and they've grown their dividends for each of the last 12 years. When we couple this with their share buybacks, Apple's returning just under 3% of their capital to shareholders each year, giving them a 2.96% shareholder yield. It's exactly what we want to see, and this is another easy check on our bonus. Apple's still looking perfect. Now it's the big metric of them all. Metric number 6 also serves as our first of 3 valuations. In it, we want Apple's free cash flows divided by their enterprise value to give us a yield attractive to the 10-year treasury. Historically, that's a yield of around 5%. So today, Apple has a $2.75 trillion enterprise value. Again, the second biggest company in the world. Enterprise value helps us look at Apple like it's a private business by adding their market cap and their net debt together. In the last 5 years, we learned Apple brought in $436 billion of free cash flow, meaning they produce $87 billion in an average year over this time. When that's divided by their enterprise value, today we get a 3.2% average free cash flow yield. This unfortunately comes in below that benchmark we were looking for, and on a current basis, Apple brought in $101 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, it gives us a 3.7% current free cash flow yield. Both of these fail to hit that benchmark, and it means coming in all the way on metric number 6, it's our first and only X of the day for Apple. Don't just throw the business out, stay for our next 2 valuations before we put these all together with the business's qualities to give a fair value and rating at the end of the video. Our next valuation uses a discounted cash flow model. We'll use their free cash flows as a base to project these into the future based on historical growth assumptions. We'll estimate that Apple grows 14% in each of the next 10 years. Then in the 10 years out after that, projecting 20 years into the future, we'll estimate that they grow at 7% annually. On top of this, we'll add in their tangible book value to estimate what their net worth is. Keep in mind that Apple is a very asset-light business, but this is likely skewed downward based on their huge share buybacks. Then to put Warren Buffett's flair on all of this, we want to figure out what an appropriate discount rate is for Apple. For Buffett, he wants a market-beating 15% rate of return. At today's valuations, based on that desired return, it looks like a DCF says Apple's fair value is around $109 per share. This might possibly allude to why Warren Buffett's been more eager to trim in recent quarters, especially as their iPhone sales are coming down. Generally speaking, it looks like Apple is stretched compared to most standard methods of valuing the business, even if it is so high quality. A GF value would imply that Apple is around fairly valued, but if we look out into the future for the next couple of years based on analyst estimates, which you do need to take with a grain of salt, the big issue is that Apple's fair value line looks relatively flat, so it doesn't look like there's going to be the same level of returns that they've had in the business. This is likely true as Apple's trading at nearly double its price to sales in the last 10 years. As much as Buffett cares about a company's numbers, he cares even more about its business qualities. Let's learn what these are for Apple so we can put them together with their valuations and their fundamentals to figure out what the business is worth. We'll start with a long thesis first. Number 1, Apple offers an expansive ecosystem of tightly integrated hardware, software, and services, which lock in customers and generate strong profits. Number 2, Apple's move to in-house chip development likely accelerated its product development and it's increased its differentiation. Number 3, Apple has a stellar balance sheet and it sends a huge amount of cash back to shareholders. Like we said though, there are some issues with how these may be allocated, as the potential for a special dividend may have been better than the share buyback authorization in the long run. It's not all a rosy outlook for Apple either. We still have to look at a short thesis. Number 1, Apple is prone to consumer spending and preferences, which creates cyclicality and opens the firm up to possible disruption. Number 2, Apple's supply chain is highly concentrated in China and Taiwan. This exposes the firm to geopolitical risk. Their attempts to diversify into other regions may pressure profitability and/or efficiency. And number 3, regulators have a keen eye on Apple, and recent regulations have chipped away at parts of Apple's sticky ecosystem. So far in our fundamental analysis of Apple stock, we learned that the business looks fantastic based on its numbers in the last 5 years. They earned very high returns on capital, they've grown, they use very little debt, they bought back a lot of shares, they've returned capital to shareholders, and they have a massive cash cushion. The issue for Apple comes for their future outlook and their current valuations. These seem pretty lofty for the business, especially compared to the risk-free rate of just parking your money in treasury bills, which Warren Buffett said he's more than content to do. High valuations still don't discount that Apple is a high-quality business. That's why it's still likely to be Berkshire's biggest position going forward in their portfolio. Still, we have to be mindful of reality. Keep in mind this analysis isn't financial advice. It's not a buy or sell recommendation of any security. Use common sense and do what's right for you. That might not be the same as Warren Buffett. Putting everything together, right now it looks like Apple's fair value is $138 per share. That's down $43 from their current stock price, it's down $60 from a street target price, and it looks like Apple is overvalued compared to where it trades at. Share your thoughts in the comments, like the video, subscribe to the channel for more, and if you're interested in finding undervalued stocks, check out the description to get free all access for 7 days to our exclusive investing tools. Thanks for watching.